Morning, everyone, and welcome to this year's investment seminar, The Winds of Change. My name is Jennifer Tozser, Senior Vice President and Portfolio Manager here at National Bank Financial. Now, this is the 10th consecutive year that I've given this presentation, and the first year that I've done it without an audience, or a live audience, but that's okay. Next year, we'll be back to live people. So, 2020, what can I say? What a year. We had 100 years of events happen in a one-year period. So we started off with the Spanish flu epidemic. We moved on to, fear of the Great Depression. We had the social movements of the 60s. We had the election dispute of the late 1800s. And finally, we had the tech rally. So it was a tough year to make money. That's okay. We made it through and we did. So to recap just for a minute back to 2019, when I was originally thinking about 2020, we were all coming off the back of a year where we had made about 18% return. So I was looking for about 5 in 2020. And then COVID hit and I was looking for about 2. But we made it through the end of the year. We actually squeaked out 10, so I'm happy about that. Now, what about 2021? Well, there's good news on the horizon. We've got a confirmed US president, and even though we are still living through this pandemic, we have light at the end of the tunnel because there's a vaccination that we expect to be widely distributed by the second half of this year. Now, what's next after that? Well, we're going to take a couple of years for the economies to get back on track. And while that's happening, the US is committed to keeping interest rates low, and that's good for the stock market. Now, are there things I'm concerned about? You bet. I am concerned about policy error as it pertains to interest rates. I am concerned about policy error as it pertains to economic policy. And I'm concerned about policy error as it pertains to the management of the COVID crisis. So I think you can see a theme here, but throughout the course of the presentation, I hope I can answer your questions about these items. Just a little bit of housekeeping, since this is a presentation that's virtual. If you have any questions, please go ahead and submit them. I will answer them at the end of the presentation. And if for some reason you have streaming problems and this isn't working for you, next week I'll have this posted up on my YouTube channel. Okay, so let's get started. Now, here we are onto our first slide. This is our agenda. And if there's any other items that you would like me to discuss, just go ahead and send me a note if I don't have them covered So next slide, let's get going. Back to normal. This is a priority across all governments globally. This slide shows how we have changed our behavior because of the pandemic. So this decrease in economic activity due to COVID is believed to be artificial and temporary. So in other words, the economy is running at about 40% below normal. So just this return to normalized economic activity could provide growth of approximately 60% to the economy next year. This slide shows us how much money the countries used to support their economies through COVID. It will be interesting to see how this plays out, but my instinct is that the countries who provided the most support are the countries that are going to get back on track the fastest. Now I would like to talk about some terms and definitions that you are going to hear throughout the presentation, and will likely be topics of conversation in the media as well. So consider it a brief crash course in finance and economics with a lot of simplification. So monetary policy, that's when there's movement in interest rates and bond purchases, and it's about providing liquidity to the economy. Fiscal policy is about managing taxation and government spending for the economy. And then there's modern monetary theory, or MMT. And that's when you pay the most attention to balancing employment and inflation, and you do that through government spending. There's an important note to make about modern monetary theory. It does not recommend increased taxation. So on to this next slide. What it does is it summarizes the effect of monetary and fiscal decisions on the economy. So what's it mean? Well, you might think that the Bank of Canada spends the day at the playground, but not quite. So let's look at the colors. Policies that are green mean go and are designed to stimulate the economy. The policies that are red, slow down the economy. And you can also see the birds circling the playground. The doves are on the green side because they want to keep interest rates low, which is a green policy, and the hawks are on the red side because they support higher interest rates. So if you have an equal number of red and green policies, the effect on the economy is neutralized. Right now, we need a lot of green policies because the economy is in a recovery phase. And although some of the red policies might be politically popular, you have to be very cautious if you try to implement them while the economy is so fragile, because they could be terribly damaging to the recovery. Oh, here's another fun topic, US debt. There's a lot of it. But over the next few slides, I hope I will convince you that we are not returning to the 2008 scenario. On the red line, you can see that we are back to the same level of debt as we had in 2008. That's not surprising. In 2008, we called it quantitative easing. Today, we called it financial stimulus. But the government was willing to do whatever it took to create liquidity in the market in order to keep the economy running. This is a primary function of a central bank. Now, this is why 2020 is not 2008. There is significantly less leverage in the banking sector. In fact, this lack of leverage and investment, despite the low interest rates, has been something that I spoke about before and points to why deflation might be a bigger economic concern today than inflation. Now, let's look at where people are overspending. I guess you could say it's in student loans. In a weak economy, people tend to go back to school, and I wouldn't be surprised to see relief in this sector from a Democratic government. Now, I think we should talk about interest rates for a minute. You should be back to me. Anyhow, the US government has stated that they are going to keep interest rates low for the next few years, and that's very good. But one of the concerns is that they could actually raise interest rates too soon and derail the recovery. And that's happened before. It happened in 2015 and 2018 in Japan and Europe respectively. And I hope that it doesn't happen this year in Canada. So on to our next slide here. Yes. Now, last year I showed you a slide that showed the yield table of government bonds, and many of the rates were negative. It wasn't an isolated event. In 2020, the Bank of England raised 3.8 billion pounds, which is equivalent to about 6.5 billion Canadian, at the rate of negative 0.003%. So that means that when your bond matures, you get back less money than when you started, guaranteed. Now, you might ask who would want these bonds. I know that I don't want those bonds, but somebody sure did because it was oversubscribed by 2.15 times. So of course, after saying I don't want them, I'm thinking, well, who would want them? So I gave that some more thought and I thought, well, first of all, you've got one group who is required to buy them. Those would be public pension plans or British pension plans. And they bought them because they felt that even though the rates were low today, they are possibly better than what could be coming in the future. And then the second group that could have bought them would be bond traders who believed that even though they were paying negative interest rates, they could make up that extra return on the currency side of the transaction. So bonds, which are traditionally something we think of as very conservative and easy to deal with, are becoming much more complicated, and you have to be really quite careful in that market. Now this next slide is actually kind of fun. It makes you say, where are your grandkids? Well, my joke about this is that if you're fondly remembering, those days where you could get 10% interest rates on your GICs and you just walked into the bank and it was pretty simple, you didn't have to deal with the markets and people like me, I'm going to suggest that that isn't coming back anytime in the near future. See, if you look at this slide, what you can see is the relationship between age and inflation. The younger the population, the more upwards the pressure on inflation. So right now in the US, less than 35% of the labor force is in that sweet spot for inflation, which is considered age 16 to 34. Compare that to the baby boomer years and the inflation effect between the 1970s and 1980s. Considering that in the US, the birth rate is 1.6 or 1.4 in Canada, there isn't a lot of inflation pressure from this part of the population. What does that mean for us? Well, we have to think differently and we have to look at different investment structures if bonds aren't pulling their weight. So let's talk about gold. Well, gold has two aspects. It's got the behavioral aspect and the fundamental one. From a behavioral point of view, People will buy gold when they don't know where to put their cash. Right now, the currency is attracting what we call T-bond refugees who are looking for what they consider a safe alternative. But behavioral isn't all that caught my interest. There are some other fundamentals that will suggest that gold will be strong. Gold tends to move with the yield curve or the future risk of inflation. So the longer we have low rates, the larger the future risk of inflation is perceived to be, so the higher the price of gold can trend. And this chart here shows the annual return of gold since 2000. When you look at this slide, it seems pretty straightforward. But what I do is use the numbers to calculate the change in trend. So if you had bought gold in January of 2013, you wouldn't have broken even until this year. In my opinion, that's an 8-year bear market. So the price support that we had in 2020 was despite the fact that the physical demand for the commodity was down by 30 to 40% in India and China. So between that recovery, the scarce amount of gold compared to the vast amount of potential interest from the bond market and sustainable low interest rates, I believe that the price change in 2020 could be the beginning of a new bullish gold cycle. Now, what do you buy? Because mining is not without risks. And what this chart shows is the difference between the performance of gold producers and the performance of the commodity price. The commodity price is blue and the producers are red. Well, I'm going to stick with the positions that reflect the commodity price, and I will stay away from the companies that have mining and regulatory risk. Now, since we are talking about the risky part of the market, let's move on to oil and gas. I am going to say this very quietly, but I think that it is possible that oil and gas has a good year in 2021. Well, why would that be? Well, first of all, if your stock fell by 50% but only recovered by 25%, there's still a long way to go. I call that the bounce. And I generally tend to stay away from that type of investing because unless you get it exactly right, your portfolio starts to behave like a kid bouncing on a trampoline instead of moving forward. But there are also some structural reasons. Over the last decade, the US became a big supplier of oil through shale. Now, not surprisingly, the production fell off in 2020, but I think that it's going to be harder to restart than you might think because shale was financed predominantly in the bond market, in the junk bond market. So look at it this way. You have to think of shale as a type of oil well that produces 95% of its production in the first year. So that's a very quick payback method, and that's great for lenders because they know when they're going to get their money. But after what happened in 2020, when oil prices went negative, things changed. So let's talk about that for a second. First of all, when you go to economics school or business school, they tell you that commodity prices can't go negative because they're real assets. Well, they did. So it doesn't make sense. But what happened in March would be an equivalent example. Let's pretend you went to the gas station, you filled up your car with gas, it was $80, you walked into the attendant and you said, here's my $80, except they gave you $80 instead. That's essentially what happened in March with oil and gas prices. So you can be rest assured that the people who are lending the money to this market didn't have that assumption in any of their risk modeling portfolios. So next year, when people go back to get their wells refinanced, it's going to be a lot more difficult because there's a lot more risks there than have been there before, and that's why I think it's going to be, there's going to be potentially less production in shale than we've seen in the past. So now what else have we got here? Oh yes, now let's talk about supply and demand. That's what we're showing on this slide is the difference. So demand was artificially reduced when we were all told to stay home. Supply is being reduced because of the lack of reinvestment into oil and gas. If this plays out, we could get quite a supply shock, and that should provide some support to oil prices. So you still have to be very careful in this space. I believe that you need to be too big to fail, so that in times of crisis, you can get some type of support from either the banking sector or the government. There is still no popular support for oil and gas, and I expect increased regulations. So like the railroads, the companies that have already built the pipelines and have the future production coming from a known place, like the oil sands, are going to have an advantage. Now, all right, back to the stock market. Well, this is a busy chart that has a lot of info on it called an index chart. You can see here that if you started investing in 1935, you would have more money if you invested in stocks than any other asset class. When you are making your investment decisions and someone puts a chart like this in front of you, it's very academic. Of course you'd want all stocks. Just look at the 2008 and 2009 dip. You can barely even see it. And we call that the Great Recession. But here's the kicker. When you're going through the market, this is what it feels like. I think that the roller coaster is a great analogy for the stock market because while we are waiting in line, we anticipate the ride. Once we are committed or on the ride, although it's fast, it's fun, but it might make your stomach turn. But if you take enough rides, you get used to the roller coaster and it's no big deal. The stock market is the same. We like it when it goes up. It is very fun. We don't like it when there is volatility. But with time and experience, we learn to accept the volatility because we have confidence that we will go back to the fun times. Here we go, the K-shaped recovery. What does this mean? Well, it means that with COVID, if as a company, you either did really well or really poorly. So if you want to compare this back to the economy, you're either a bike shop or a restaurant. So the S&P 500 closed up 14% in 2020. So is it poised for a correction? Is it overheated? Well, the S&P 500 is not the economy, and the name is misleading. You might think that it represents 500 American companies equally, which would be about 20 basis points of contribution to the return per company. But that's not how it works. The bigger the companies, the more important its contribution to the index return. So the top 10 companies represented approximately 1/3 of the return in 2020. And when I checked in December, the median return of a stock in that index was 0. So do I think it's overheated? No, but let's just look at some other indicators to make sure. If we look at the overall market, the forward earnings are in line with where they should be. So they're not too hot, they're not too cold. Okay, so now let's pick apart the indexes. IT was the clear winner in 2020. Is IT overvalued and everything else on sale? Well, maybe. Let's look at the next slide. I would tell you that it's getting expensive, but it's not nearly expensive as it was in the 2000s, as identified by the magnitude of the gap between the red and the blue lines. Growth is scarce. Quality companies are scarce, and people are willing to pay for that. Now let's talk about all the other miscellaneous items that we have to deal with next year. Let's start with healthcare and pharma. In the past, this has been a popular era for reform. But when you come out of a healthcare crisis, you get more social and healthcare programs. But what we need for COVID is a vaccine. And you don't want to put the group bringing you out of the pandemic into the penalty box. So this should relieve a lot of the pressure to reform Big Pharma. And on the back of this, we are going to talk about supply chain. Supply chain refers to where you get your stuff from. In globalization, we have been taught to believe that cheaper is better. Why make a pen for $1 each in the US when they only cost a penny in China? Well, the answer to that became very clear last year because when 90% of the pharmaceuticals that you require are manufactured in China, if the whole world needs them, you have to get in line behind everyone, including China itself. So this pandemic has shown us that when you get a demand shock, everyone wants it. Combined with a supply shock, you can't get it. It is useful to have inventory on hand. And I'm not talking about clothes and cars here, but medical supplies and food. So expect to see more domestic manufacturing and attention to supply chain. Big tech. This is another group that's under attack. Politically, they have a bunch of issues like antitrust and tax, but what I think is the underlying driver is power. And the political question is, how do you swing the balance of power from big tech back to the politicians? Without question, these stocks dominate, but how do you regulate them? So let's talk about some of the issues. Back to me. Okay, so antitrust. Are they monopolies? Well, if you're a monopoly, that means you control the market, but you have to control the market to the detriment of the consumer. So if Google's giving away their search engine for free and it costs you $9 a month on Netflix instead of $60 on cable, it's a difficult argument to say that the consumer is being harmed. So let's talk about the next thing. Let's talk about what I consider their predatory practices. So let's say you have a company that's going to create good competition for one of these big tech. They don't worry about it. They don't panic. They buy the company. and they integrate it into their own business, and they have war chests of cash to do that with. Now, I think that that could be a place where you start to see more regulation, but there's actually a structural issue with that. If you don't let the Microsoft, Oracle, and Walmart buy the TikToks of the world, because it's a global market, then a Chinese company can come in and pick them up. And if that happens, that gives them an advantage and puts the Americans at a disadvantage, and there's a big race going on right now for dominance in the tech market. So let's talk about the third item, which I consider data mining. So we all know that that tech search engines know what we want sometimes before we do. So you type in something and it gives you some suggestions. But there's criticism that when your suggestions come up of whatever they are, there's preference given to Amazon's own products or Facebook's own products, et cetera. Well, that's already under fire in Europe, and I expect that we're absolutely going to see regulation about that here in North America. The next one would be, what about breaking up a conglomerate? Well, breaking up a conglomerate is a pretty traditional, business move to unlock value from each market segment, so from each segment of the company. So think of Amazon, for instance. They said, okay, you got to break up. Well, there's three obvious divisions. There's the online retailer, there's the clouds business, and then finally there's a streaming business. If you separated all those three, all you'd probably end up doing is unlocking value to the shareholder. And we've got lots of examples of this from as far back as Standard Oil, or even, within the last 20 years here in Canada with the breakup of CP. So let's talk about tax now and tech companies. Well, first of all, US tax rules are murky, and I do not claim to be an expert on them, far from it. So here is a slide showing the effective rates that big tech has paid. Pre-Trump, marginal rates were 35%, and Trump dropped them to 21%. Biden wants to increase them back to 28%. But there's a lot of criticism because the tech companies never paid anywhere close to those marginal rates. Well, what I think isn't identified in this chart was the treatment of the repatriation of cash from overseas. You see, Apple and Microsoft had 90% of their cash stockpiled outside of the US. Pre-Trump, it would have cost them 35% in tax to bring that money back and use it in the US. So Trump dropped those rates to 15 for cash, 8 for non-cash, and he gave them a period of time to pay it back. So as these companies repatriated their cash, it dropped their effective tax rate. Now that doesn't show anywhere in this slide, but I also think it was a great policy because you get to tax on money you weren't going to collect, and you get investment back in the US because the money's back instead of overseas. I could spend much more time on this slide, but it comes down to your personal beliefs about tax. My questions are, does big tech get some type of tax advantage that is not available to other corporations, such as big pharma? Or is the issue actually the tax code? I can't answer that question. But my opinion is that when the default approach to problem solving is to raise taxes, you aren't actually addressing the problem. Oh, Canada and the US. Well, most Canadians breathed a sigh of relief that Biden won the election because Trump's personality was just too hard to take. But let's move on from people to policy and which new Democratic policies may affect us. Okay, so Biden has his first day in office, and the first thing he does is cancel the Keystone Pipeline. I'm going to tell you that was pretty predictable. He campaigned on it, so TransCanada's next move is to continue with their old lawsuit against the US government, and this time for billions of dollars. But what about everything else? Well, the US might stop allowing exploration on Crown land. That could be good for Canada. They might create a tax based upon the environmental impact of the oil produced. That should be good for Canada, but who knows how that one will work out. And then the bigger issue is Chinese relations. The US and China could force Canada to choose who they are going to side with. Currently, 70% of our exports go to the US and 15% go to China. So this is a very tricky issue. This is a pretty fun YouTube video if you want to spend 15 seconds watching it. But the point of it is that we've printed a lot of money throughout this crisis, and that makes people nervous. So are they going to raise taxes, either marginal or capital gains taxes? That's always popular. But if you remember my teeter-totter slide, that could be poorly timed right now. The other problem with those two types of taxes is that you are only affecting a narrow part of the population. Remember, 50% of Canadians have less than $100,000 going into retirement, and 68% of families own their own homes. So what I'm really worried about is a tax on housing. Because if you want to raise a lot of tax revenue, you have to go where the bulk of Canadians have their wealth. Now, finally, to touch on guaranteed basic income, although Liberals were promoting this idea in December, Trudeau said it isn't a current priority. Now, because all of this money printing is non-intuitive, there are a group of people who think that this was irresponsible and traditional reserve currencies are no longer safe. And there's another group of people who feel that the next evolution of finance is digital, and that brings us to cryptocurrency. I've spoken about cryptocurrency before, and I do not think it will be able to compete with a government currency, and here's why. They are mainly traded in unregulated markets. There is less to no investor protection. There's opportunities for fraud, manipulation, cyber attacks, hacking, theft, and there's uncontrolled volatility. But even if all of these items could be addressed, in order to be considered viable, it would need to have critical mass, but there are still two major hurdles. One is that they facilitate anonymous transactions, and two, it's hard for countries to tax. So because of that, governments will likely regulate, ban, curtail crypto or Bitcoin before it can reach critical mass. Oh, look, it's a cartoon of my house. When you hear all of those conspiracy theories out there about COVID, I'm going to put forward my own. I think it was Nintendo. But seriously, I'm going to talk about policy error and not parenting error. I do not envy the politicians today who are forced to create policy around COVID where there is no modern precedent. So they are pulled between practical issues, emotional issues, and financial issues. So where do you start? Oh, it's me. Well, the first problem is that there is no standardization of anything. How do you define a pandemic? I mean, what is it? How is it different than an epidemic? I mean, we can all go online and we can look up and you can send me a definition. That's not what I'm talking about. But is it how many people get it? Is it how fast it travels across the globe? Is it based on the percentage of people that contract it that die? Is it based on the percentage of the population that dies? That's where there's no standardization. And when you don't have standardization of a situation, then all you have is a relative decision. And when it's relative, it's very complicated. You get mixed messages and you don't know when you're in trouble or when you're not. So this next slide is going to demonstrate that. This report we get every day, have for about a year now, from National Bank's head office. The data is compiled by John Hopkins, who I'm going to tell you is a reputable data supplier, and these charts show the outbreak trend per million. These charts are from December. So you can see here that the Maritimes are green, which is good, and Alberta is the highest, and red, which is bad. But this is where the lack of clarity of definition creates problems. You see, the next chart beside it is exactly the same analysis, but a view of states instead of Canadian provinces. States that have the same number of cases per million as Alberta are green. So why is 377 cases per million terrible in Alberta and fine in the US, according to John Hopkins? I have no idea, but it's confusing. So this is where I see a risk to COVID and policy, is that we are trying to solve the problem through regulation. Now, I'm going to give you an odd example here. I'm going to just pretend I'm going to talk about I'm going to talk about alcoholism. So if you think about alcoholism and you know it's a problem in your society, you can choose to solve it through regulation. You can ban alcohol. Well, they did that. They tried that. We all know that that didn't work. So what they did instead is they said, all right, here's some guidelines. Here's some education, and here's some support for this problem. I think that's what needs to happen with COVID. Right now, how we're trying to deal with the COVID problem is to solve it through regulation. I don't think that works. I think what we need to do is move to that more modern understanding of how to solve the problem, and that's going to take some time to get there. So now on to the next slide. Oh, this is kind of fun. Look, it's me. I'm a cartoon. I always wanted to be a cartoon. So what's this all about? Well, last year, I talked about ESG, which is environmental and social governance. So this year, I thought that it would be fun to take the portfolio and see what the score was. So I went to the MSCI website, ran all of the stocks that we hold through, got their ratings, took the average, and we got an A. So I was pretty happy about that. Now here's the thing. ESG is interesting, but it can sway your decision making. So the stock with the lowest ESG rating in the portfolio at the time that I did this was Canadian Natural Resources at BB. And even I considered exchanging it for Suncor, which had a better ESG rating. But here's the problem. CNQ outperformed Suncor in 2020 by about 25%. And between December and today, CNQ's ESG rating went up. You've heard me say this a million times, but the primary investment decision always must be the company. Dividends, taxation, and ESG can only be secondary considerations, or your portfolio won't work and you won't know why. Oh, now we're getting towards the end of this presentation here. We're coming back to our auto callable notes. Many of you have seen this slide 5 or 6 times. You could probably present it, but I'm going to go through it again because they're volatility plays, they're not intuitive, and I just think it's a good reminder. So this here was a live note that we did years ago, and it was based on the S&P 500 index. If you invested if you invested $100,000 when the index was at 1,400, 1 year later, if the index was 1,400 or greater, you got 8.25% return. If it took 2 years, you got 16.5. If you took 3 years, you got 24.75. Okay, this is all fine. Nobody's worried about any of this. But what if it doesn't work out? What if you're sitting here 3 years later and the index never went up? Well, these things have a barrier of protection, and the barrier of protection on this specific one was 20% or 280 points. So if you're looking at the index 3 years later, it was at 1,200, you're inside your barrier of protection, and you get your principal back, but you don't receive any interest payments. So what about the other chance? What if it was worse than -20? Well, if it was -22, you get -22. I call that the disaster clause. And the reason that when you think about those, I know that they're there, you have to be careful about them, but I don't think it's a significant risk, because remember, if things go wrong, most of the time these go up, but if things go wrong, it's much more likely you'll be between 0 and -20 than less than -20. And when you're between 0 and -20, the bank has to pay and they never want to pay. So these are only issued in limited dollar amounts for limited periods of time. Now here's our performance on these notes in 2020. It was a tricky year because, as we know, the market was junky for a solid 8 months. But we had 9 notes that matured in their first year with an average return of just a shade under 14%. And we had 21 notes that rolled into their next year. We have 4 notes that are rolling into their second year. And since 2013, we've had a total of 75 notes called with an average return of 11%. Now here's something new that I started to talk about and put in your portfolios this year, which are income notes. And I had to look at these because the bond rates were dismal. Nobody's making any money at 38 basis points. So how these work is these are very similar to the auto callable notes. They're based upon an underlying index, such as the bank index. They have a barrier of protection. But what's different about them is that their rates are a lot lower. The rates of return are, kind of the 5 to 6%, maybe 4% range. Their barrier of protection is large. In this example, it's 50%. They don't pay once a year, they pay every month, and they even pay if the index is negative. So what you can see here on this blue line is the performance of the index, and on this example, the client would be paid their interest every month, even though the index was negative. And then when it gets above, in this example, 10% at the end of 42 months, the note's called and we have to find another one. So on to the summary. If you take a look at this, if you look at some of my forecasts for GDP growth, which of course I don't make up, I get from a variety of sources, you can see the ranges are pretty big. That's because we're coming off of a weak year where things have been negative and not a strong year where things have been positive. That's why there's such a big range. If you look over onto the asset allocation side, this is generally what I'm looking for next year. You can see that I've added an allocation for income notes. That's come out of the fixed income section. US equities are about twice as important to your portfolio as Canadian, and I've added a global equity component of about 9%. These are just the individual types of investments, and gold and global infrastructure have moved up the scale. I like to take a look every year and see who's growing their dividend. That's always very important to me. So that's what this list shows. And here's another list that just shows who's been paying dividends for a long period of time. I also like to see that. Finally, in addition to the research we get from National Bank, these are other providers that we use. Some are very expensive, some are very inexpensive, but it's all designed to help us make good decisions for your portfolio. Oh, it's from my lawyers. They have to say hello. And then we are now ready for questions. So what I'm going to do is you should be back to me, and I'm going to have to move a little bit closer here so I can actually see what the questions are. Where are they? Oh, we're just bringing them up right now. Oh, wait, there are no questions. Oh, yes, I think there are. Just give me a second. Okay, there was a question about whether there's concern about increasing taxes on capital gains. I do think that that could happen. It's a popular political stance to say we're going to raise taxes on profitable people, or which we perceive as rich people, remembering that over half of Canadians don't even have $100,000. But the problem is that it's a restrictive policy and we need to get our economy going back on track. And this has not been a good year. People aren't sitting in it with a whole bunch of capital gains, so you probably won't collect the revenue you want. If you would like a copy of this presentation, a hard copy of the presentation, if you haven't asked me for it before, and if you have, we already put them in the mail last week. I apologize if you don't have it. If you need one and you haven't asked me for one, I will just send me an email because my questions are coming up as anonymous, so I don't know who you are, and we will drop you one in the mail. I'm just going to wait a minute to see if any other questions come in. And you know what? You can always just ask me questions afterwards as well. If for any reason you had to walk out of this presentation and come back and forth, it will be posted. It will be posted on YouTube. Oh, I've just got another question. What would a Canadian election mean for our portfolio? Well, now you're asking me which way the Canadian election was going to go, and I don't know which way it's going to go. But I would suggest that if there's an anticipation of an election, you're going to want to make as many people happy as you can. And doing things like Liberals who are currently in power have money too, and they don't want to pay more tax right now. They also have to get all their businesses back to normal. It's an economics question. So on that slide, what's an example of non-financial debt? Non-financial debt would be household debt, or it could be consumer debt, or it could be student loan debt. A question about the US dollar and the Canadian dollar. Well, the Canadian dollar right now is predominantly always moves with the price of oil. So if we expect to have a good recovery in the price of oil, that's good for Canada. That could be good for the dollar. If Canada raises interest rates, that in the short term will be good for the dollar. But what I think is that it could be if you raise interest rates right now when your economy is weak, I think that's a bad economic policy. So it could be short-term good and long-term bad. And I think that's the end of our questions. Okay, so thank you very much for coming to my live presentation today. Please send me some feedback. I'd like to know what you think. And other than that, I hope you have a great day. Bye for now.